Hello, hello.
We're trying to fix my computer.
Yeah, technology, even though it's so smart, there's always something.
Yeah, because he told me a second number was coming and I didn't call him because I didn't see one. What is this? So I had to tell Miguel on the weekend I have it. And so he'll copy and send it to you. So you'll be able to get the questions, the complete questions, including the ones that you all will give me today. Ah, you thought I forgot, right?
Which questions?
Aren't you
Oh,
all supposed to
you mean
tell
the
me
ones?
the questions you should ask?
Yeah, I sent that in, but I talking about the ones that we're waiting on you from are for
What?
the stuff we discussed last week, right?
Yeah.
Okay. I was just
Hold
making
on.
sure.
What are we supposed to do? Good evening.
Good evening.
We're told that less than 10% of Bahamians.
I thought that's a
What was the assignment? Sorry,
Who
I
doesn't
totally
tell
missed.
me to pick? I'll get it tomorrow. Maybe home. Yeah, you remember now, Darcy?
No, ma'am. I'm trying to figure out what the assignment is now.
I said for homework, try to figure out what questions a director would ask if they were to appoint a CEO.
Oh, that was a homework assignment. Okay. All right.
Yeah,
Yeah.
you remember it now.
Yes, ma'am.
Okay, so
I thought
that's what I.
I thought it's just a point of conversation.
There's a point of conversation, but I say come up with some questions so we can discuss it, and then we'll begin our chapter on risk management and corporate governance.
Okay, no problem.
All right, so you need a couple of minutes to think. I know Danielle has hers. What would you, Tessa? You have your questions?
Yes, ma'am. I sent them to you via email late last night.
Oh, the bus was late. Hold on.
Wasn't super duper late. It was just a little late.
That's 11 o'clock. I already cut this off. Okay. Okay, I see you have the first point there. Mm-hmm. Okay. Mm-hmm. Okay, I see your I word. Okay. Mm-hmm. Okay, not bad. You really gave this some thought.
I did a lot of reading.
Okay. That's not bad. Darcy, you need a couple minutes? Danielle, you did anything? You have any thoughts?
Sorry, I drive in.
Oh, you drive.
I didn't write. Yeah, I did. I won't be home for another, I would say, half an hour or so. I have some thoughts. I didn't write them down, but I have some questions in my head. I don't know if I'll be able to share them while I drive.
Okay. Yeah, you probably can. Let's see what Darcy need a couple minutes.
Okay.
And then we'll go into risk management.
So I'm basically interviewing a CEO as a director. That's basically what we are.
Yeah, no, what the things that you really should take into consideration? Yes, if you were to interview as a director for a CEO position, what you should be looking for.
I would ask about the work experience, their skills. I'd ask about their vision and how would that align with my company's vision. I would ask about whether or not they have any conflicts in taking on the role. Give me a few more minutes.
Okay. Danielle, what you have? Off your head, you could remember.
So I had the same thing. What is the your previous experience within the field? To that, I would add, what is your particular skill set? And does it bring what we need to the organization? So if it is that we are looking to modernize our operations, if it is that one of your skill sets is, in information management, then that would be a good fit for us because you would have the technical background. But there's also, what is this person's reputation within the industry? I would add to that as well.
So Tessa has hers. She said, is there a CEO succession plan in place? And if so, does it require a review and update? What is the timeline for the CEO succession? Is there an emergency succession plan in place? What are the skills, experience, and traits required of the CEO in carrying out the company's strategy? And all of you have said that one. What qualities does the board appreciate about its current CEO that are to be expected from the succeeding one? What is the relevant process or steps required by the company's articles for the succession or appointment of a new CEO? What direction is the company heading in? And is the current strategy successful in achieving the company's goals? How may a new CEO assist in moving the company forward? And our last one is, are there persons within the company who may qualify or be considered for the position? So everybody is more or less within the right area in terms of the questions that you should ask. So let me tell you what my research says. First question, are company strategy and executive succession explicitly linked? 2, is a board process in place for evaluating the CEO and potential successors? 3, does the board explicitly assess the CEO's management of a succession plan for the next generation of company leaders? 4, is the board leader driving the succession process for the CEO and direct reports? 5, is the board working to retain a high-performing chief executive, but also to keep capable successors? 6, does the board have a member who could serve as CEO in the wake of an unexpected exit if no insider is yet ready for succession? 7, has the board compiled comparative data on the inside CEO candidates from those who had worked with all of them? 7, have directors and direct contact with both the CEO candidates and the information sources to verify information about them? 8, if executive search consultants are retained, have they been vetted to ensure that there are no conflicts of interest? 9, does the board ensure candidate confidentiality? 10, has the board gathered independent references on the outside candidates? And 11, is succession planning embedded in the company's culture?
Are you able to share that with us?
Yeah, I've copied it already. So when Miguel gets them, it'll be all of them. You'll have the ones from last class and this one. I've copied that one already. So you will have those. Now they went further and talk about how do you spot a falling CEO? A director should have a checklist so they could know when a CEO is falling, you know what I mean? Not doing what they're supposed to do. So number 1, absence of a clear strategy. 2, lack of focus on a few dominant priorities, dislike or follow through, under anticipation of unintended consequences, over reliance on the decision making of a senior executive, captive of special advisors, and last, functional executive appointed to line position without line experience. So that's we talk about a falling CEO. So I can copy this page too. Then they have a next list on how to retain, revive, or relieving a chief executive. The chief executive missteps and aberration that coaching by the board leader can overcome. If missteps are more than an aberration, what additional corrective actions are warranted? Is the CEO capable of strengthening the leadership capacities required for full revival? Does the board have information about the root cause of a company's decline? Do most of the directors believe that the CEO is faltering? Is the board's annual evaluation of the CEO focused on leadership indicators, not just financial metrics? Have directors and the CEO coach other executives on how to work with the board? Does the board learn directly from and about executives who report to the CEO? If moving toward relieving the CEO, are most or all of the directors of common mind? And lastly, are performance matrix and severance terms well in place before advancing towards dismissal? So those are the ones they list for if you how do you want to retain, revive, or relieve a CEO. So I'll copy that one for you too. So let's turn now to risk. Let me put a little marker here so I can remember to copy that. All right, so risk governance. Because risk means anything that poses a threat to the company. Management is a process. And intelligence is you learn from your experiences about risk. And then you use that knowledge to understand other risk and how to mitigate against the risk. So in any organization, this is why it's always not good to get rid of seasoned persons, because they have a lot of the risk knowledge, which is based on experiences that the company would have gone through. So when you speak about risk management and responsibility, they have different levels. Risk governance, that's at the board level. That's where they do strategic decision-making, and they're responsible for risk oversight. And you know they're responsible for risk oversight because each department has to report to the board. And risks themselves have to give a report as to risks that are imminent, or if there have been breaches, or whether the policies and procedures need to be updated. Then you have risk infrastructure. So that's developing, implementing, and maintaining an effective risk management program. And that's normally what's done by senior management. And then at the very bottom is risk ownership. And risk ownership depends on each department or each sector or each section. They are responsible for identifying, measuring, and monitoring the risk that's inherent in what they do. And of course, the risk department would report the risk, if not the risk committee. So risk governance direct and define the level of risk that the company is willing to accept. They set the monitoring and the alignment between risk itself, its appetite for risk, and of course, their expectations. So the general staff, they have to take ownership of the risk. And when you talk about taking ownership of the risk, they're relying on the information that's within the organization. Any risk that would have happened over the years or over the quarter, that's that risk intelligence. So when you talk about risk itself, you'll see certain terminologies they use. You'll see enterprise-wide risk. You hear them talk about risk appetite, risk reporting. All of these have to do with the whole concept of risk. And we know that risk has been a topic in every sector after the financial crisis. All of them had to do with risk and corporate governance. The failure in most organizations is not simply that they just lost money. It's that they had a very poor corporate governance and they did not understand and mitigate against the risk that are inherent in the business that they operate. So when you talk about a risk infrastructure, look at the first diagram. If you're looking at a bank or any company, the front line, the business unit, the people who deal with all of the clients, they're the first line of defense. After them, you have risk. And then you have the third line, which is the internal, external audit. So in the second line, you have your risk management function. If it's internal, you have your compliance function, because both of those are risk. And then you have the internal, external auditor who would actually review what's done on the first line and the second line. So within these three, first, second, and third line of defense, that's where you identify your risk, you evaluate it, and you manage it. Once you finish with the third line of defense, it depends on how your organization is structured. You could have a risk committee, you could have an audit committee. If you don't have those two committees in the middle, they collapse. Then you would have a report that comes from the second line and a report that comes from the third line. So that means you'll have a report going to the board from compliance, a report going to the board from internal risk, and then you will have internal audit and external audit reports going to the board. So the board then needs to know what they accept and what they don't accept, and whether or not the first and the second line are actually monitoring the risk. And are they giving accurate reporting and timely reporting to the board in order for them to be able to say, yes, risk governance is taking place in this organization, and we can continue doing business as we are doing it. Any questions? No?
So in smaller organizations, like you said, it wouldn't really have like a risk management committee or audit committee. They would just have like their frontline team, and then they would have their compliance team, and then they would have like an external audit or internal audit team. And they would
Yes.
all report to
Yeah.
the board.
Because the internal audit normally does the AML risk, and they may take a mandate to look at special let's just say compliance notice that corporate governance is not being done properly. There are a lot of things that seem to be missing, going to the board. Then they in turn can ask for finance to arrange with the internal auditors to come in and do a review of just corporate governance. And that would go to the board. So there are different types of risk. You could have strategic risk. So that's looking at the organization's objectives. You could have operational risk. That's looking at being able to execute your strategic plan. You have financial risk. That has to do with whether or not you're making money or not, whether you have the right liquidity. Compliance risk, we know is both legal and regulatory. And then reputational risk, which has to do with your firm and your branding. So you could take risk and you could categorize it different ways. Based on your organization, you can say these are our major risks, these are other significant risk, and then you have unrelated risk. So it depends on your business. Let's say your core business is lending and trust business. So you can say your major risk is credit, liquidity, market, operational, and fiduciary risk. But bear in mind that those are not the only risk in the business. So if you want to say these are your inherent risk, you also have residual risk. So if those are your inherent risk, then you have residual risk such as settlement risk, interest rate risk, because it affects lending. You have country risk, depends on where your clients are. You have transfer risk. You have technology risk. You have regulatory risk, reputation risk, and compliance risk. And then, of course, overall, you have moral hazard and systemic risk. And then further down, I've broken down risk categories in a different way again. So everything depends on the company and the nature of the business that they're in. So you, instead of categorizing your risk as major, other significant, and unrelated, you can categorize it as financial risk, your information technology risk, your legal and regulatory compliance risk. You could then move to your human resources risk, your market strategic risk, your operational change risk, and then of course, your audit risk. So the different ways to categorize your risk. So each risk has its own definition, and each risk has a different effect on your business. So what you do with these risks is what we're gonna do in the next two pages down. Because what you have to do is you have to take your products and the services that you offer your clients, and you need to do a risk assessment of them, which means looking at the product or services and being able to determine what are the risks when we offer this product or service to our clients. What are the residual risks when we offer these? Then you ask yourself, do we have an adequate policy and an appropriate procedure in place to deal with the risk? So companies which are part of a group, they normally use an enterprise risk management system. And in that, they tend to determine what are the risks for every product and service that they offer worldwide. And at the same time, each entity determines its own risk appetite. They normally use that also to compare it with peers, people offering the same products and services and in the same target market, or internal audit reports. So most firms, they try to focus on being more proactive, and trying to develop their risk management capabilities in order to get a competitive advantage. So if you try to recollect, in the early days, when anyone ran a company, it was all about how much money can you make. So even today, The focus is still on how much money you can make in order to have a successful business. But in more than ever before, everything is around corporate governance and risk because of all of the financial crisis. So the trend across industries is to establish an enterprise risk management program and implement it across all of the organizations around the world. And you include in this risk management framework a culture, a risk management culture, where everyone is aware of the risks that are inherent in the business. They know of the residual risk, they know of the policies, they know of the procedures, and they know how the risk is being monitored. And they're also aware of the reporting to the board. Any questions? No? So below I've given you a risk governance model, and it's quite in depth. It's trade, capture, and processing. I have the pricing, the position, analytics, trading, straight-through payments, and risk compliance. Then I've given you the operational processes, such as risk appetite. So if you know you're doing trading and capturing and processing, you need to have a limit. And then you need a capital allocation. Then of course you have credit risk. And then underneath credit risk, you see risk identification, client onboarding, rating and credit analysis. You have credit limit and you have credit monitoring. Then of course, once you're dealing with credit, you have market risk. So you have to identify the risk in this segment, your limits, and how you're going to monitor it. Then of course, you have operational risk. You have to identify it. You have to look at the operational risk view. Of course, with operational risk, you always have fraud, so financial crime. And then your loss data. What's your threshold for losses? Every organization has a threshold. When it gets a certain amount, then it has to be reported to the board. And then they list the other risks, such as qualitative risk, funding and liquidity risk, new product risk, risk adjustment, and performance measure. And then last but not least is regulatory compliance. And then the next column deals with the measurement. So the measurement for capital maintenance is of course regulatory capital and economic capital. Credit is looking at counterparty risk, exposure, collateral and netting, rating, securitization. You have to look at the Basel calculation for capital, concentration, country risk, and other credit risk. When you look at market risk, you have to look at exposure, sensitivities, market position calculation, price valuation, gap risk. So if you read this across, then you will see that with every risk, there is a measurement and then there is a control. So look at the control and reporting, management information, board reporting, committee reporting, control reporting, balance sheet management, capital management, portfolio management, funding and liquidity, risk adjustment view. And for a lot of people who work, it doesn't have to be a bank, it don't have to be a security, it doesn't mean insurance, it could be any large company, especially those who are public companies. People who deal with risk have to go through this whole process of identifying the risk, finding the residual risk, knowing what the processes are, how to measure it, and then what to report to the board. So when you look at the first line of defense, they have to be able to say, okay, we're issuing a new product. We're doing mortgages at 3%. So the first thing they have to do is a new product, they have to do a risk assessment. So a risk assessment means you have to start by first saying, what's the risk? So that's risk identification. What is the risk when we offer mortgages at 3%? What's the analysis we have to do? And then what's the risk evaluation? After you've done that, then you have to think about how you're going to monitor and review this risk. How are you going to treat it? And then you have to deal with communication. So whenever you have a new product or new service, you have to go through this whole risk management process. And you have to write a report to the board based on this flow chart as to how the risk has been identified and how it's going to be measured, evaluated, and reported back to the board. So let's go through risk identification. Mortgage 3%. What you think? What's the risk you think is in that? Offering mortgages at 3%, or 2% or 1%. What's the risk? Is it a risk that you'll have a lot of people who wish to transfer their mortgage to your bank and then are unable to pay? Especially during the pandemic. So that's a risk. Then you have to say how you're going to mitigate against that risk. What processes are you going to put in place, or what additional checks are you going to do? You have to put that in place. Then you need to say how you're going to monitor it. Is it going to be a department that is going to be doing follow through to make sure that these people have a job every 3 months? Or is it that you're going to have to get confirmation from their employers every 6 months or once a year? So this is the monitoring part of it. And that means that you have to keep up with the changes and you have to be reading the report. So who's going to be reading the report? Because there's a lot of monitoring to be done. Who's falling behind? Who has one payment? What happened when you have 2 payments? How many calls do you make? And all of this was a learning experience for the banks during that last period 5 years ago, when they had to come up with a whole new strategy and looking at the risk in mortgages. And then of course there's documentation, which means you have to take your policies and your procedures and you have to see where they need to be updated and then present those to the board for their approval. So remember what I said, normally, even for a very small organization, they still try to do an enterprise risk management framework. And they try to do that so that they think, so to them, they're able to capture all of their risk in a snapshot. So I've given you a little brief snapshot of a qualitative risk analysis. And that is where you would put your risk and you put your categories and you'll be able to see where exactly that risk falls. And the more severe it is, that means that has more reporting. So when you talk about enterprise risk management, there are some certain questions that you need to ask yourself. And especially if you sit on a board, you ask yourself, what are all the risks to our business strategy and operations? And I can tell you a lot of board members don't even think about these. All they think about is they have a package, they have some documentation, and they read the documents and they say, I agree, I agree, I agree. But being a part of a board involves much more since the financial crisis. You have to understand risk and risk in general. So let's say you come on the board, you're an accountant, or you come on, you're a lawyer, or you come on because you're a broker, they're doing brokerage business. You still need to know the overall concept of risk. And you need to know overall what is corporate governance and how does risk and corporate governance work together. So the second question you ask yourself is, how much risk are we willing to take? And that counts for your risk appetite. And if your risk appetite statement does not give you that answer, then it is not written properly. Because every board member is supposed to know how much risk the company is willing to take. Then third, how good are we at overseeing risk taking? Which means you have to look at the composition of who handles risk. Do we have the right person? Do they have adequate resources? Have they been able to identify all of the risks that are inherent in the business? And these are the questions that a board of directors is supposed to ask themselves and raise these questions when they get reports. The fourth thing, how do we ensure we have the right information to manage risk? So that comes from a director knowing what are the inherent risks in a business and looking at either the internal audit report or the external audit report or the report from risk, which identifies the key risk that are important to the organization at a certain point in time. So yes, there are inherent risks in the business, but this year, the high priority risk could be credit risk, settlement risk, and corporate governance. Next year, it could be fiduciary risk, operational risk, and financial risk. It will not always be the same. It depends on how the company is operating. So you as a director need to know what risk you need to focus on and whether you're getting the right information to ensure that the executives are doing what they're supposed to do so that the company itself is not exposed to additional risk. So the next question you have to ask yourself is, how do we determine the size and scope of the risk and report the results? So when you get your report, you have to be, as a director, you have to know what size risk are you looking for? So remember I told you when there's an operational loss, there is an actual limit. So the board, let's say the board set a limit that any operational loss, 10,000 and more must come to the board for approval. So let's just say you had a 5,000 risk, $5,000 loss. But that loss, by the time that loss occurred, there were other losses affecting other parts of the operation. So now the board have to determine what's the size and the scope of the risk and how is it being reported? Because don't forget, they have the answers to the shareholders. The next thing is, how well do we manage the risk? Which means that when the board sits, the board does not spend a lot of time discussing what we call more or less static documents, such as like policies or reports. They really should be focusing on strategy, risk, and the financial position. Those three things are important. Those three things say whether or not the organization is actually making a profit and whether the organization is being run according to the standards that have been set. The next thing is, what are we doing about the risk? If every time there is a report, more and more risks are coming up, that means that the first line, number one, is not following policies and procedures, or number two, the second line of defense is not doing a very good job at risk assessment. They're not identifying the risk as the product changes or as the client changes or the interaction with the client changes or the business changes or the competitors have changed their ways and the company just decided, okay, they're going this way, let me do it the same way they're doing without doing a risk assessment as to whether or not it is good for the company itself. And then the last one is, what else can go wrong and how are risks interconnected? So this is when the board member now decides to ask, to raise some questions. Okay, you say you have this risk, but this risk is connected to that risk. So why is there no mention made of it? Why isn't there a connection between these two risks? So let's say if you take credit, if you take credit risk and there's an issue with credit, then you need to ask about liquidity. You need to ask about capital. You need to ask about market, The next risk could be interest rate risk. So there are a lot of risks that are interconnected. And as a director, you need to know which risks are interconnected with the risk that's the topic of the day. So as the director, look at all of these things and ask all of these questions when documents come to the board based on the board's agenda. The critical point for running any organization is culture. The culture is at the heart of what an organization does. And if you don't have the right culture, the organization will not live. You will have breaches upon breaches, and you will not reach your strategy, and you will not make a profit because of culture. So the compliance function is always to make sure that the organization has the right culture. And to do that, they have to report to the board whether or not the organization, that's everybody, including the board, understands the culture of the organization. Any questions? I know I said a lot in one time. No questions?
When you say culture, you mean like the culture, like the environment of the organization and its industry and the regulatory and risk implications surrounding that specific industry?
No. Culture means within the organization itself, the staff are aware of, number one, the company's risk appetite. Two, all the laws and the procedures and regulations that go with the company. They know from senior management, communication coming from the board's tolerance for certain things. That's the culture. It's the people. And how the people follow rules, how they follow the policy, how they follow the procedure. Because they're the building steps for the board, ensuring that they give the shareholders a profit. If you have a front line who doesn't care, they're not following procedures, they do whatever they feel like doing, they come to work late, they eat lunch late, they eat lunch in front of the customers. What do you think that means? For an organization, it's a bad culture.
Yeah.
The culture is always that you follow the company's policies and procedures, and you're always looking out for what is in the best interest of the company. So that's what the culture is. The culture is always a culture of compliance, a culture of always putting the company first, doing what's in the best interest of the company. So on the next page, I have the interrelationship between ERM, internal audit, and compliance. So I know a lot of people know compliance is a job by itself. Auditing is a job by itself, and they all the specialist fields, and risk is also a specialist field. You'll see now, because of the new AML CTF framework, that the legislation now requires every organization to conduct a risk assessment. And so now you see a lot of people are now trying to get certification in risk. So who isn't doing it in compliance? They're doing it in risk. So what's the objective? Enterprise risk management is to identify, prioritize, and assign accountability for managing strategic, operational, financial, and reputational risk. And its scope is any risk, because that's why it's called ERM. It's any risk that can impact the organization's ability to achieve its strategic objectives. And the owner of that is the chief risk officer or the chief financial officer. So in some instances, they are separate functions, and in some instances, the chief risk officer reports to the chief financial officer. Internal audit, you all know the objective of that. Determine and prioritize risk to aid in developing the internal audit plan, helping to provide the board and executive team with assurances. So every year, the audit team would come and decide their audit plan. So internal audit is normally done, like for this year, it'll be the internal audit plan for last year. And the scope, financial statement and internal control risk, as well as operational and compliance risk. That normally would impact the performance. So everything depends on what their audit plan is for the year. And then of course, it's the chief audit executive or whoever's the lead auditor that's assigned by the external firm. If the internal audit is done by external firm. And then you have compliance. Identify, prioritize, and assign accountability for managing existing or potential threats related to legal or policy non-compliance or ethical misconduct. So the role of compliance is really, one is the culture, and secondly, it's to make sure that you don't have any fines, any penalties, any reputational damage, or inability to operate in the key market. That's why compliance is one of those resources that always must be adequately staffed. Because it actually helps in monitoring all of these risks. The scope is the laws and the regulations that the company operates in. And of course, depends on what they do. There are also market conditions. And if there's more than one regulator, that means laws and regulation for every regulator and every market in which they operate in. And that's for the chief compliance officer, takes on that role.
Ms. Archer, in some instances, if you have a small company, wouldn't the ERM also fall under the compliance officer per se, because it's really like analyzing the company's risk? Because if you don't have a chief risk officer, or I guess you would probably have a financial officer.
The CFO will do it.
Okay.
Yeah, the CFO will do it. Because don't forget now, the compliance officer reports to the board. It only has a dotted line to the CEO in terms of preparing the, I guess, for the salary part of it and all of that. But even the assessment of the compliance officer is done by the chairman of the board.
Okay.
Yeah. So for risk management, there are some questions, a little bit different from the other ones we said earlier. What are the risks to the business strategy? How much risk are we willing to take? How do we govern risk taking? That's the culture, the governance, and the policies. How do we capture the information we need to manage these risks? How do we control the risk? How do we know the size of the various risks? What are we doing about these risks? What possible scenarios could hurt us, and how various risks are interrelated? So since the financial crisis, a lot of companies do stress testing. And stress testing is done normally twice a year. And that's looking at the various scenarios and making sure that the company either have adequate capital or adequate resources to deal with stress testing. So whenever an event is to occur, so right now we're in what? March. And so we have to look at beginning the end of May, beginning of June. You need to do a stress testing for the mid-year. And that stress testing now would be coupled with more than just looking at June and persons traveling abroad, but now you're looking at the pandemic, you're looking at hurricane, you're looking at earthquake, you're looking at tourism being an all low, no cruise ship. And so for a lot of organizations, including banks, there's a lot of stress testing that needs to be done. Because if things don't pick up, then of course, you know, that means more loans will not be paid. People still will not have savings. People may have to decide they want to break their fixed deposits. We know with the banks, they have the penalty. If you break your fixed deposit before time, it's a huge penalty because they have all now moved on to Basel III, where they have to keep a required amount of their deposit as a capital buffer. So it's a lot of things that a bank has to take in consideration in doing stress testing. Any questions, comments? None? So that's one of the key things now that you see a lot of boards are asking for stress testing results because of the uncertainties. So now let's focus on corporate governance. So remember when we did unit 1 or we did company law 1, we started off by saying a bank has 2 organs, the shareholders and the board. And the power between the two are different if it's a private company versus a public company. So if it's a small company, the shareholders can act as directors. And they have to understand the difference between the two roles. And they have to realize that when they act as a director, they're acting in a fiduciary capacity versus when they act as a shareholder. Because a shareholder does not have a fiduciary duty. If it's a large company, the board has a supervisory role with its powers being delegated to executive management. The shareholders focus on capital growth and income and ensuring that the composition of the board is balanced. So when you have a private company, as you know, because it's private, the shareholders sit on the board. Most of the persons on the board are family members. Only as they start to grow, you see they would start to diversify the composition of the board. If it's a public company, then of course it's regulated and the composition of the board is very important. So look at my little chart on the corporate governance and let's see where we start. Board effectiveness. For a board to be effective, they need to have director protection. So whenever you're appointed to a board, that's the first thing you ask. What is the insurance? What is the liability coverage in this role as a director? Board evaluation. You should have a document that speaks about how the board is to be evaluated. The remuneration should be set out at the same time when they say that they are hiring you to be a director. How much am I going to be paid and the frequency and the mode? Next, director selection. So we did that already when we did the last one. What are the criteria for selecting a director? What is a director induction? What kind of training do they get? And did I mention to you the director's handbook? Because that's normally how the induction takes place, where a handbook is prepared, giving an overview of the organization, its policies, procedures, remuneration, hours of work, all of that is in the induction handbook, employee handbook. And the next one is director development, which means that they have to be a part of the annual AML, mandatory training, and you should also ensure that they do corporate governance training. That's for the board effectiveness. Then the next thing is the role of the board. You have to look at the board structure. You have to look at the role of each individual director. You look at the role of the chairman, the role of the company secretary, which we did last time, and the role of the CEO. We did all the three of those. That's the defining governance rules. You have to know each role and what is expected of each person. Then you have the key board functions: strategy, the CEO, the monitoring, the compliance, risk management, policy framework, networking, stakeholder communication, and decision-making. That's how a board functions. Those are the usual things that go to the board for their approval. And then next one is improving board processes, which is the meeting, the board meeting agenda, board papers, board minutes, board calendar, and committees. And we did those in the last class. Any questions? No? So corporate governance from a banking, trust, corporate service, money transmission business, all of it. When you talk about corporate governance, the definition was sent out by the OECD. It doesn't change much. A lot of people may change the wording around, but it's still more or less saying the same thing. It's a set of relationships between a company's management, its board, its shareholders, and other stakeholders. Corporate governance also provides the structure through which the objectives of the company are set and the means of attaining those objectives and monitoring performance are determined. So good corporate governance should provide proper incentive for the board and management to pursue objectives that are in the interest of the company and the shareholders and facilitate effective monitoring, thereby encouraging firms to use resources more efficiently. So corporate governance provides the underpinning for relationships, responsibilities, and reporting lines for the board, senior management, shareholders, employees, clients, and other stakeholders. So really, in essence, corporate governance is about how you run a company. Knowing the difference between the shareholders and their role, the board, and all of the respective players on the board, which means knowing the role of the chairman, the role of the CEO, the role of the corporate secretary, and being mindful that the majority of the contributions made at the board is made by the CFO. Then you have to understand that there are committees, and you always must have in an organization the 3 lines of defense. First line is the front office. The second line is compliance and a risk person. And the third line is the internal, external audit. So corporate governance is looking at all of that, knowing what is to be reported to the board, knowing what risks are inherent in your business, what are your residual risks, knowing that you're receiving your reports on time, that they are accurate, and that those who prepare it know exactly what they are doing. So the stakeholders for whom an effective corporate governance regime operates and benefits are, of course, at the very top, the shareholders. Then you have the employees, you have investors, you have your service providers, and then you have the community at large. Because depends on the organization, you actually would be giving out, making sponsorships, as you can see in the papers. Normally, when you look in the sports section, you would see some organization gave a check for this charity. All of that is a part of corporate governance, because you cannot be a part of the community if you're not giving back to the people that live in that community. That's a part of social responsibility. So at the center of a good corporate governance is you must have the proper understanding, appreciation, and practice of the high standard of duty, skill, and care that's expected of directors and senior management, and how they actually discharge their duties and responsibilities, internally and externally, within the ambit of the law, the regulations, and international best practices. A lot of persons, once they become a director, they think about the law, they think about the regulations, and they forget all about international standards of best practices. because to them, they think it's not law, it's not regulation, so you don't really need to follow it. But in time, they do become a part of either regulations or law. You must have a comprehensive understanding of the responsibilities and the accountabilities by directors and senior management. Clear, consistent communication of the process of good corporate governance. And that's another pet peeve you see in a lot of organizations. Senior management don't write clear and consistent communication to the board, because you have the right to the board based upon, take it from the flip side. The same questions I say that the board should ask itself, when senior management write to the board, their writing should be in answer to those questions. So to have an effective corporate governance regime, you need to know risk and you need to know compliance. So look at my beautiful little chart in the middle there. I have statutory, regulatory. You have laws, statutes, and regulations. Then you have standards, ISO and NIST as information security. Then you have the policies. Then you have contracts and commitments. Then you have policies and procedures. And then you have contracts, controls. So from a governance perspective, these are the things you would normally see on an agenda. The only thing that doesn't go to the board would be procedures, because procedures are for staff. Policies, processes, and procedures do not go to the board. Policies go to the board. Standards do not go for approval either. They may be sent for information purposes. Statutes and regulations are part of the compliance report when there are changes. So then look at risk. Risk is categorized as that: select controls, access controls, implement them, authorize, and continuously monitor. Everything to do with risk is always monitoring and making sure that you have the right people to carry out the job. And then compliance is monitoring, self-assessment, external audit, and then reporting. So an integral part of the mandate of directors and senior management is the same risk management process, being able to identify, measure, monitor, control, and minimize the risk to the organization. And all of those things depend on the size of the organization, the products that they offer, the services they offer, whether or not there are threats of money laundering, fraud, collusion, impropriety. You have to be able to identify what threats are out there towards the organization. So one of the measurable criteria to know that you have a sound corporate governance program is making sure that the information you receive is accurate, is reliable, it's timely, and is relevant. And it actually looks at the thoroughness of the organization's risk management system. You're looking at the frequency and the effectiveness and the productivity in which directors and senior management are able to obtain information. So let's say the quarter end was March. So the board meeting is in April. Of course, all of the documents will be dated as at March 31st, so the end of the quarter. But the management representative who is giving the presentation should be able to tell the board of directors or answer any question as at that point in time. So let's say at that point in time, they would have said that we have identified an additional risk, or we have a residual risk that we're gonna have to move up as being an actual risk. Instead of being residual, it's an actual risk. And we have policies and procedures in place. And we've estimated on the scale of our risk assessment that there's a 30% chance that this risk may actually increase to 40%. So you in front of the board, you making this report. This is as on March. You should have already anticipated in your mind that when you go before the board, they may ask you, what is the level of risk now to us? That's the question you should be able to answer. Is it still 30 to 40? Or did it move to 45 to 55? Is it down at 20? And if it is at 20, what did you do? If it is at 55, what do we have to do? So all of that is being able to say you have a sound corporate governance program, is being able to give accurate and timely information and relevant information so that the board can make a decision. So if you are a licensee under the Central Bank of the Bahamas, they require that at the end of your calendar year, you have 120 days as the board of director to make an attestation or certification that you have checked all of your controls. And you need to report if you have any material deficiencies or weaknesses or problems that you have identified. And you need to say how you have assessed it and how you're going to monitor it. Include with that your action plan and your timeline for remediation. So once that is received by the central bank, they expect that the board will monitor the deficiencies. And they're going to follow up on it. Because I can tell you, if you report a deficiency, you start reporting on it, you will see them when they come to visit you. Because they're going to see if what you reported is what you've actually done. So annually, you have to document whether you have a good corporate governance process, and it is effective and it is successful. So the first thing to know that you have a good corporate governance process is, do you have your 3 lines of defense? Do you have a good compliance culture? Are the right reports going to the board? Are those reports timely? Then they look at the contributions that are made by each director at the board meetings. Are they giving meaningful comments? Are they asking relevant questions? All of these determine whether or not you have a good corporate governance process. Now, your external auditor may also be engaged in your annual review because it's required that they assess the methodology followed by the board in analyzing whether corporate governance process in the organization is adequate or not. And the auditor then reports to the board and the inspector if they see any discrepancies of the board's risk management assessment. So overall, we know that doing all of this corporate governance and all of this information that flows back and forth, there is the duty of confidentiality. And that duty of confidentiality came from the common law case of Turnier versus National, Provincial, and Union Bank of England. And in that instance was when the client's information was given to its employer without the client's consent. And the court ruled that that was a breach of the company's duty of confidentiality. So the duty of confidentiality is a contractual one, and it is premised upon the express and or implied terms of the banker-customer contract. But we've seen where it's moved not just in banking or trust business, we've seen it move into other realms of business, that duty of confidentiality. So it doesn't apply only to a customer's account information, but it also extends to information related to the customer's identity, the assets, the liabilities, and any other financial affairs. So that means that you cannot disclose a client's information to their spouse to their relatives, to another financial institution, or any unauthorized parties. You're only allowed to divulge a client's information if it falls under one of the 4 exceptions. And one is you have a duty to disclose under the compulsion of law. So if there is a request from the Attorney General's office, or there's a request from the police, or there's a request from FIU, your information will be sent out. Yet the duty to disclose in the public's interest, which means that if the bank thinks that whatever activity that you are carrying on is detrimental to the public at large, your information will be disclosed. Third, duty to disclose in the bank's interest. If the bank feels that by not disclosing it, it will either ruin the reputation of the company itself or ruin the reputation of the jurisdiction, they will disclose your information. And lastly, the 4th one, they have a duty to disclose by express or implied consent of the customer. So when you sign that account opening form, you will see there's a very fine print whereby you have given them your express consent for other affiliates of the organization to contact you to market their products. Be mindful that the governor, he has the power to provide information on the beneficial owners, the directors, the officers, and operations of any of his licensees to a supervisory authority around the world. But there has to be a connection. So it has to be either it's the head office or it's for consolidated supervision. Any other request comes through the Attorney General's office. Of course, the governor has the power to provide the same information to a domestic regulatory authority, such as the Securities Commission or the Insurance Commission. So the duty of confidentiality, like I said, extends beyond just bankers, and it's gone on to other financial services professionals. And it's been the nexus of the financial business in the Bahamas. So if you look on page 132, you'll see a little chart that I found. It speaks about the changing environment of confidentiality and how it is eroding. So this was India. They're looking at a digital ecosystem. It will facilitate the digital lending value chain through online data sharing and authentication for underwriting. China, banking authorities have released draft rules with regards to digital lending, increasing regulatory interest as market is already growing with multiple players. The EU have their second payment services directive, allows customer for direct payment from their accounts. You have the US, their BIT licenses are being issued to businesses engaging in virtual currency activities. And in the UK, opening bank account will allow sharing of bank data to authorized organizations in standard format. Opportunities for fintech firms to use data for creating products and credit assessment. So what's the position on the Bahamas in this changing environment of confidentiality? Let me hear what you have to say. Darcy, what's your take on that?
Can you repeat that? Sorry.
Confidentiality, eroding confidentiality. I just showed you in each country where they're moving to this digital age.
So your question is what I think about the digital age and the duty of
The digital age, do you think the confidentiality is eroding in the Bahamas?
eroding? I wouldn't say eroding, but considering the digital age, especially in the sense that And sorry about the noise in the background. My kids are that.
No, I can hear them.
Especially, okay, especially in the age where a lot of the companies in Bahamas, whether they're using like these third parties to provide them with digital services. Um, I would say it's only eroding to the extent that service levels agreements are not solid and concrete. But I wouldn't say it's eroding just because we are entering the digital age. The digital age do bring a lot of sharing on platforms that may not be exclusively in the possession of one particular entity. But I say to the extent that the service level agreement speaks to that point, confidentiality, then that scenario would be one where the confidentiality would be protected. I do believe our data protection laws need to be revised to consider the digital age.
They said
But I
they
think
said they were doing that 2 years ago.
we still got a lot of catching up to do because I do note that the technology and the digital companies and technology age is moving way faster than our legislation and our regulations. I, in my previous employment, worked for a digital payments company, and the central bank, in my opinion, would not and still isn't equipped to even regulate them. That means even from a KYC perspective, because the paper's going away. That the whole point of business for these companies is to do everything digitally. So that means a lot of information is on either somebody's cloud or somebody's server. The only thing I commend them on is mandating that the servers and the information systems be located in the Bahamas. But if the regulator doesn't have the technical capabilities to properly regulate that aspect of it, then I mean, I guess brings me back to your question. Then I
Yes.
guess in that sense, yes.
Yes. Because my whole thing is that everybody now, remember when they first started out with this digital thing, all the big G10 countries were saying, oh, no, we're not regulating that. No, we're not. No, it's to be used for money laundering. No. And I don't know whether the big countries then decided or saw the usefulness of it, because overnight, all of their talks changed and they all implemented legislation. So now all the small countries like us are now trying to catch up to get a part of this market, and they have moved well far beyond where we even envisioned it would have been in this short space of time.
Yes. I know locally, but even in the space of the Sand Dollar, I've had the privilege to face to face up in a few conversations with the vendor for that, which are which is the good or bad part of Korea. South Korea is the good part, right?
Mm-hmm.
I think the South Korea company is the vendors for that, and Zia. And the language they're speaking to the regulator, meaning the central bank, who's pushing for it, I can assure you they don't understand it fully. They're catching up. But your information and everything of a national initiative to that extent is in somebody else's hand as a nation. Now that contract between NC and Central Bank better be ironclad, but they have a lot of information in their hands. A lot of information.
Yeah, it's really, I'm trying to figure out how are they going to keep the client's information confidential out there in space? How are they going to do that? In the cloud. I was like,
Yeah.
how are they going to do it? How do you balance security with this efficient method of doing business now? How do you balance it? And if you are a board of director or a CEO of such a firm now, as everybody's moving towards it, what do you do? It's just and there's no guidance to tell you how to do it.
No,
First thing I do though is you better hire the best technology expert or contract the best technology, at least to be advised. For those companies like Francis, the whole confidentiality is wrapped up in encryption. But still, with that encryption, the access controls is totally within one person or one entity's hand solely. And that person is not the regulator.
Exactly. Yep. And everything is now moving towards that. No matter what you're doing, if you're doing banking, you have to move towards the digital what do you call it? Digital exchanges or digital platform. So eventually banking is going that way. Securities is going that way. People selling their assets that way. So the whole concept of banking in the next, I would say 20 years will not be as we know it.
It might be less because COVID
They're moving fast.
accelerated that movement. So it's moving 10 times, at least 10 times faster than it was.
And get right. And COVID more or less confirmed that that is the way to go.
Justifies, yes.
Yeah,
That's right.
justified.
Now you see, we don't see if we had done this, now everybody could transfer money with their wallets, their phones, this, that, the other. Oh, you don't have to come in the branch. Just upload this, upload that. This, that, the other. You could send your money to this one, send your money to that one, through this API, this, that, the other. But who is understanding that language? I'll always come back to that.
No, and then more than that, it ain't just as simple as implementing it. The banks still have to make money. So they got to see how they can make money.
Yeah. Well, I can tell you as a bank, it's a challenge, and we have a lot of committee groups and steering committee groups that that's the way of life in a day-to-day right now is trying to figure these things out. Really analyzing these new waves of products and seeing if it makes sense from a profit perspective, and not just a profit perspective, how to get this legacy client base to accept what's, I wouldn't say it's being jammed down our throats, but lack of a better saying, it's being jammed down our throats.
Yeah, because if you don't keep up to date with this digital, you will be left behind.
Right, I have my 80-year-old daddy. He'd give my email to everybody to use for him. I know all his business because all he knows is everybody's asking him for email. So he called me one day, asked me for my email. I gave it to him. I didn't think nothing of it. Next thing I know, all this business coming through my email. So I have to, good thing I'm his son. But I have to protect him because he have no clue that that's his information. Now we dealing with cards.
He wouldn't know. He wouldn't know. But think about those persons who are blind.
Yeah. He dealing with cards. They pushing them to the machines. If you come in the bank, then you gotta pay transaction fees, or you have to go to a different threshold. And then my mother, who's younger than them, she don't even understand this language.
No, she won't. No, she won't. So imagine moving from using the ATM machine now to going to put everything digital. How is that supposed to work?
I mean, the other concern is also just like cybercrime is going to be, you're so susceptible to cybercrime when everything is online. Like I know a lot of times, especially persons like the elderly, they get caught because they're opening these emails that they shouldn't be opening, and there's certain servers that aren't protecting that. So if simple things like that aren't in place, I mean, if you think of that on a government scale, right, you have to have proper server and protections in place and firewalls in place to protect all of this data and protect all of this information. And it's and also human error. I mean, if you have staff, if you don't have the proper protections in place where certain emails cannot be received, and a staff member opens an incorrect email that then, it spools from there, and you end up getting hacked or something, then that's another issue.
Yeah, it's a lot. It's a lot to think about. do also, if we're looking at this topic here, you got to think about if as the companies evolve into this digital world, you have to go and rethink all about risk. You have to go and rethink everything about corporate governance. What exactly am I looking for? What should I be receiving? If you don't know, it's gonna be very difficult.
But like I say, I go back to it, but as an industry, and this goes for any country, the regulator needs to be the leader and this type of thing for guidance on a corporate governance standpoint and guidance from a management standpoint beneath corporate the executive that's responsible for the corporate governance framework. Because if they are not there to do what they are supposed to, which is regulate, then we can have all kind of different threats in terms of risk that is not being managed.
Yes, we will. Yes, we will.
Like I said, I'm a former I wouldn't say employee, but I had a contractual agreement with a payments company, and the regulator, all they had was the standard from a KYC and compliance perspective, AML and compliance perspective. All they had was the standard for brick and mortar bank and trust companies for financial service for compliance. That doesn't fit a digital payments company, because when you're talking to me about paper KYC in branch, face to face, this, that, the other, when the whole model of a digital payments company is in your phone, paperless, anonymity is a big sky high risk, and you're talking to people in a digital space. Like, what is the regulation? What am I supposed to be complying with?
Yeah.
You're not telling me that as a regulator. What you're going to tell me is, oh, it's coming. When is it coming? When the business is already here, up and running. So all these threats are embedded now. When are you going to catch up? What are we supposed to do? Do you even know? How are you even going to get there?
Yeah.
You have these companies being, these companies are the regulator or have the knowledge. So they're guiding the regulator. So that in itself is another level of threat, because a malicious company or somebody with an intent could guide you down the wrong path as the regulator.
Yeah, it's a scary world out there. It really is. It's a real scary world. All right, so that's it for tonight. Next week, we're going to talk about these things that just fall right in line. Continuing on with our conversation, we're going to talk about, what's the next one? Oh, I don't like that one. Not that one. Not that one. It's factoring.
Yes.
What? The Foreign Accounts Tax Compliance Act?
Yes.
What about CRS?
CRS is here too.
What? Take it
It's
easy
on
on us, Mr. Take it
Huh?
easy. Take it easy on us, eh?
Why?
I know. The automatic exchange of information, them things are complex sometimes.
And then after that, we're going to do e-commerce and data protection and look at the EU laws on data protection.
Okay. One question for you, Miss Archer. The
Go
exam
ahead.
format. I heard a rumor that another class is having face-to-face exams. That's true?
You heard a rumor? That's not a rumor. That's a fact.
That's a fact. So that's
Yeah.
gonna be a first too.
Yeah, unless you talking to Miguel. I don't know if he's going to do any online.
No. I know our company's one. That's 2019. Obviously, it was COVID, but we didn't do that. So I just was curious.
Oh, yeah. Now it's more relaxed.
Okay, so May 3rd is
Yeah.
an in-class exam.
Yeah, in class exam.
Okay, thank you.
May 3rd? There's a face-to-face exam?
Yeah, they can spread you out in all the rooms.
Okay.
Yeah. So, yeah. So that's it for us tonight. So we'll do FATCA and CRS. Everybody knows FATCA and CRS, right? I've already heard Darcy's comment.
I that's bits and pieces.
It's
Yeah,
relatively
I wouldn't
easy.
say I'm too familiar with it. That's not something I come across.
Oh, Okay, okay, all right.
No,
Of
I mean, and obviously I'm in banking. I have some familiarity.
course you know it.
I mean,
Yeah,
when
I'm
you
in
come
banking.
across some of these banking forms and these tax forms, it just looks like gibberish.
It ain't that bad, man. It ain't that bad.
I mean,
Yeah,
you have
cause
like 20
it ain't that bad,
pages
cuz.
of like questions that sometimes are half relevant and not relevant at all. And you're like, do I
Yeah.
fill this out? Do I not fill this out? What is this for?
Yeah, that's true. That's true. Now, when you say that point, you're correct. A lot of those things we don't have to fill out at all, and that's why we normally ask the client to have their tax attorney complete it.
Exactly. But you gotta
That's the
keep in
best way to
mind
do
though.
it.
I mean,
Huh?
this is a conversation for next week probably. But you got to keep in mind though, those forms are designed to capture the true people who understand that language. So the person who that's designed for, they familiar with those type of things.
Right. Because you could give that to a tax attorney and he'll tell you just do line 1, 15, and 24, and you're done. You'll be there for weeks. Okay, so what that means? What that means? You fall under that category. Do you do that? No. You need a tax attorney.
And they'll have like acronyms, but they don't define what they're for. So like as somebody who doesn't know, like if you didn't know what FATCA was and the form was a FATCA form and it didn't state what it was, you would be so confused. A lot of forms are like that. They'll have CRS or they'll have like acronym, like I said, acronyms, and they won't define it. So if you don't know what it is, you're just like, what is this?
Exactly.
It's plenty
Yeah.
acronym too.
It is.
So that's why you always have their tax attorney look at it. So when you take it as an institution, you said, okay, this is what you submitted to me. This is how I will report you.
And
There's
from an
nothing worse,
institution,
yeah. There's nothing
and from
worse
an,
than you interpreting it and then you report to people and you shouldn't have.
and it gets more complicated because from an institutional perspective, we're always careful with our staff to say, "Oh, we ain't in the business giving advice because you don't go through us."
Mm-hmm. They always make sure that they give you the information. But sometimes they call back and ask you the information because they're too cheap. So there's all of that you have to think about. All right, that's next week. We'll talk about those things.
Good
So
night.
question, just circling back to the exam. I know.
Go ahead. 2 people spoke one time.
No, so midterm is due on May 3rd, as is the capstone.
Capstone is due on the day of the exam.
When is
Every-
midterm? This midterm question due?
May 3rd too.
The same day we
Everything is
agreed.
due
Yeah,
May
we agreed
3rd.
to yeah,
Okay.
we'd agreed for
Okay.
everything on the same day.
But those that we submit those via email. They don't
Via
have to come in.
email, right.
Right. Okay. And then the exam.
No, he may do it on the Saturday.
Okay.
What's
Okay.
May 3rd? What day that is?
That's a Monday.
Oh, okay. Well, you need to let me know if that's convenient. Because if not, then I'll see if he could do it on a Saturday.
Okay.
It'd be better if we could do it on a Saturday.
And
because
Yeah.
then I would
But let me know by next week. Next week we could bring it up. Because Danielle couldn't make it tonight. So let's see if she agrees. And I can send a note to Miguel and tell him y'all want to do it on the, what is May it? On the 8th. On the 8th.
Hold on.
From 12 to 3.
Sorry, what on the 8th? My apologies. I was talking to my daughter.
Oh, no, we trying to wait till next class when more students on and see if they agree to have the exam on the Saturday instead of from 6 to 9 in the night
Yeah, I
on a
vote
Monday.
for May 8th.
Saturday, I'll say 12 to 3.
Yeah, that's better.
Okay.
all
Let me
the-
put it to Miguel now and let me see if he's inclined to go that way. I
vote
think
for
the
that,
rest of the class, the rest of the class would probably
I
agree.
agree.
Shalisa vote for that. Sorry, she couldn't make it tonight.
Yeah, okay. So let me write it down now. May, what it was, 3rd?
May 8th.
No. What it was before? What it was
Third.
before? The 3rd.
Third, and we're
Scratch
moving
that
it
out.
to the 8th.
Make it 8th, 12 to 3 p.m. CRS and FATCA forms.
Boy, you better have your digital signatures and proof of signatures. Jeff, I don't know that story.
And that's another issue that's come up now, digital signatures. Because a lot of people using the computer signature, which is not a signature.
No,
Yes, it is. The act
I
is
mean-
covered.
Yes, it is.
The
yes,
act
yes, it is.
recognizes electronic signatures.
Yes, it is electronic signatures, but then
You mean the ones that
Certain
generated by the
things,
computer
no.
itself?
Yeah,
no, there
No.
are
yes.
there are apps that allow you to generate electronic signature and the presence of those already made electronic signatures. Yes, that's acceptable.
You can create your
challenge
own
becomes-
signature in Adobe Acrobat. You can create
Yeah.
your own signature,
Right.
and then when you sign a document, and you save that, you can't amend that after that. You can't amend that
Correct.
signature. It seals it. You can't do anything with it after that.
The challenge becomes on the institution and when we're verifying signatures,
Exactly.
and the responsibility is on you to make sure whatever other signature you coming up with matches your documents.
And
I
it
don't know how you can
doesn't
do that.
match it. Right.
Not,
Because the
not
signature
cleanly.
you have on your passport or your national identity card is not the signature that machine produces. They're not the same.
But you can set it to produce that. You could set it to fix whatever signature you want. You just sign it like that and save it in the program. And
Yeah.
it'll
I
fix the
know.
same signature.
I know, but what we're saying is that the customers are not doing that.
No, they're not doing that. They're using
not
the
doing that.
electronic signature and what's in the passport. That's where the conflict comes.
Exactly.
We have one big row right now regarding unmatched signatures, and that's another point of contention.
Yeah, well, yeah, we just had one of the same thing because on the passport it's a swirly and whatever. And then when you send the document is, you can see it's a computer generated. So they wrote out the name. The computer wrote it out DANILLE, and that is not how the person signs at
But
all.
that's because the person don't know what they doing. But you just have that with people who sign in hand signature.
Yeah, but the
they
people
come,
want to
they come with
argue.
a whole other signature
No,
and
but
sign that, and that ain't what in the passport.
I
The bank don't take
know.
that either.
But then the client wants to argue. Oh, you all are sent and you all accept digital signatures. This is no, but it don't work that way. It don't work that way because it doesn't match any of your documents.
Ain't none of y'all work the Commonwealth Bank, eh?
No.
Oh,
Okay. Because they the signature police. And the Commonwealth Bank, they the worst thing. That's the worst. They're the worst. The worst.
No, but let me tell you what it is though, and it goes back to the regulator because the bank I'm at, we had a challenge too, and we reached out to the regulator for some guidance, and it's almost like we are completely on your own. So it goes back to those institutions' risk appetite. You know, there is a measure of liability you got to be concerned with because some of the signs, some of it doesn't match, and then something goes south and it materializes in the litigation. The company doesn't have really don't have no defense. Because that
No.
person can come back and lie and say, no, that wasn't me. I ain't signed nothing.
But the
And
woman
this, that, the
made me sign the thing. She gave me the card to show me which signature I supposed to sign. I signed it just like that. She said, "Diane, look like that." She gave me a card to
Yeah.
change the signature.
yeah. Like I said, it's a big
Change
round.
the signature and then sign the same thing on the card. I say, "Miss, I right in front of you. Like, what is this? What is happening here?" She said, "Don't look enough like it." So I had to make up a whole other signature to give to
oh
her.
my.
I don't even
Yeah.
remember what
No.
that signature is now. I had to take a picture of it. I didn't even know what that is. I
Yeah,
don't
like I
even
said,
know.
it's a big row going on right now, trying to find that balance.
But it's funny because
Yeah.
there are a lot of people who don't even sign their passports. A lot of people don't even know that that's something you have
Yeah.
to do. I receive passports all the time that are unsigned, and I have to go back to the people and be like, "Listen, your passport is unsigned," and they're like, "Why? Why do I have to sign it? Where am I
No.
supposed to sign it?"
You
Who
know
does
who I
that?
blame? You know I blame for that? The passport office, because I recently got my passport.
You
And
should
I
sign it
was
before
like,
you
oh,
leave.
I was like, do I sign this? The woman tell me no, you can go and sign it later. I said,
Really?
Okay.
My passport is unsigned. I figured if they wanted a signature on it, they would have captured that signature digitally and put it on there. I didn't know I could take my passport away and put whatever signature I want on it.
Don't worry,
You
whatever
have to
signature
sign
you
your
put on that,
passport.
that's your signature.
Yeah, because if
No, you don't
yeah.
have to sign your passport.
Yes.
It depends on depend who the passport employee is. I can tell you that. I'm telling you. I was standing there waiting for the woman to tell me, "Oh, watch me sign." She said I can sign it later. I said, "You sure? You sure?" And she looking at me like, "Why is she signing to the window?"
Yeah, my name been signed since I got that. And I had that for how long?
Oh,
I
I
guess
always
if I knew I
sign
had to
mine.
sign it, I signed it.
I sign mine every time. Always sign mine.
Yep.
So, you
We
too?
have that
better go
issue
and sign
with
it.
people for gaming licenses. Because the people have passports and passports ain't signed. So what we compare that signature to, we have to ask for all kind of different ID.
But
Yeah,
even on
that's when.
driver's licenses, the driver's license is so small, the signature, that it's so hard sometimes to even compare it to the original signature. I mean, you're looking at these driver's license sometimes and you're like, oh my gosh, is that the same or is it different?
Well, it don't matter anyhow, because they're just selling them.
You stop being so wicked. You stop. That is not a good thing to say. Oh my God. What I could do with you? What I can do with you? You're so messy, though. Oh Lord. Okay. That's the best joke yet. You have to stop. I thought they stopped that. I thought they arrested some people.
Drive
I know.
only in the
They selling
Bahamas.
everything. The registrar general's department selling your marriage certificate, selling your ID. Use it to get married.
Nazata,
NIV, passport office. Everybody's just selling up information. Trust me.
guess what they say is the solution for all that?
What?
Some digital implementation.
Child, please. Digital? They can try to put everything on digital,
Yeah.
and then afterwards, no one be able to retrieve no
Of
information.
course
They
not.
Watch.
eliminate the fraud and this, blah, blah, blah.
Yeah, they could be all right. Watch them. They can put everything up in the cloud and can't get it back. It could be hacked and they don't even know what the people took.
Yeah,
That's true.
that's true.
That's what could happen. That's exactly what could happen. So, they better take it. I know they trying to stay on the cutting edge, but the people are not at the cutting edge because even the kids in school at the cutting edge.
That's my thing.
My.
We going so hard this thing, but we don't have no experts.
No, we
The
don't.
experts working in the interest of their own jurisdictions, not us.
No,
And any experts we might have had, they didn't leave the country for better jobs.
exactly.
That's another
They
thing.
only
Ain't
want
nobody
pay
want
you
to
a
hire,
pop-up
ain't
because you're
no
Bahamian.
government want to hire you, want to hire no Bahamian to do something like that, and then they don't want to pay you what you worth. So
Yeah.
I was
that's
at an
the next
offshore
thing.
bank, and the IT experts, they keep flying in people and paying their full
Yeah.
tuition and their full room and board, while the behemoths are just looking up.
They was just talking about that last week, how when they bring in the expat, this guy was saying at the offshore bank like years ago, so they bring them in, they give them house, they give them car, pay for the children's school fees, pay for the children extracurricular activities. Then they offer them 2 trips per year back home. And so the trip back home is not a direct flight.
No,
Trip back home means leave here, stop in Costa Rica for a week, stop in Canada for another 4 days, and then go home. So
And
you
they
couldn't
could-
tell them how to get home. So because
and
they are going home.
and they live far. I talk about these people in
Yes.
Africa and in far
And
Europe
everything
and
is paid
Asia.
for.
Mhm.
Everything is paid for.
They should go ask for $5 raise. They're looking
Can't get it. Can't get it. That's probably why everybody bleaching. See how white they could get.
I live that life, so that's the God honest truth. I've seen it happen, and in fact, some of the experts is my friends, so I know they live in.
Yeah, they living good.
I
They
mean,
live in.
with that type of salary and benefits, you could literally probably educate 3 additional staff members. You could probably educate them, like give them, like to get them to the qualifications that you need and still
Yes, you
save
could.
and
Yes,
still
you could.
save money in the long run.
Yeah, yes, you could. You could. You could go to UB.
Yeah, but they don't want.
They
a
don't
lot
want
of
it
these
though.
companies,
They don't want it.
they don't want it. And it's several reasons why. One, they tend to work with people that they've known in their previous life. So if your boss is an expat, what they're going to do is they're going to bring all of the other people that they can that they used to work with them. So they're an expat VP, their director is going to be an expat, and it's probably going to be somebody that they've dealt with in their industry where they came from, because that's what they're accustomed to dealing with,
Mhm.
as well as they don't have proper succession plans. So when it is that an expat leaves, they're trying to scrap to find somebody to put there very quickly. And that has to be a person that can hit the ground running.
Right.
And then lastly, they don't want to make long-term investments in people. They want short-term return. So they're fine with paying all that money so long as when you arrive on the island, you could do everything that you need to do. They don't want to have to spend that money, then wait 2 to 3 years, in between for you to get up to speed. And in the interim, that business is suffering. So it's a lot of things that's happening with
Yeah.
that whole that situation. And I worked at a hotel, so you know what it's like there.
Mm-hmm. Yep. So unless you're like one of those old time people who went off and did some training long time ago and came back, nothing happening for you.
Mm-mm.
Nothing. No room to get nowhere.
Nope.
None whatsoever. And it's sad because, we keep boasting of all these things, but our people are not getting the knowledge that they need in order to rise to these positions. It's just not happening.
Yeah.
Yep, it's rough. All right, then. Y'all have a great week.
Okay.
Have a good
And
Have a
week.
good week and enjoy Easter, everybody.
oh, yes. Enjoy your Easter holiday. I forgot. I'll see you all right after Easter Monday. So please don't go to the beach and get sunburned.
Everyone be
Oh, no.
safe. If you're
Oh,
traveling,
so
be
no class
safe.
next week.
So we're not having class on that Monday, right? No.
Oh,
Not
that's
the
a
holiday
holiday.
Monday.
Hold on. What did my book say? I just put my book back.
Well,
What
I
did it
think
say?
it skipped it.
It
I
does
think
skip it. We don't have
schedule
class
skipped
till the
it.
12th.
Yeah.
Okay. All right. Who you say who traveling? Who traveling?
I say if anybody traveling, be safe.
Oh no, those tickets are too high.
I maybe.
I heard
Who
it's
say I may be? Darcy, you
I
Right.
heard
traveling?
it's crazy.
Darcy, you traveling?
I sure yeah. I might be though.
Plus you got a test and
Okay,
everything.
baby.
And them
Okay,
tests
okay.
expensive.
The cars are expensive.
Yep.
The airfare is expensive, and plenty Negroes over there.
Yeah,
Can't even
yeah.
get on the plane.
No, if I do, I ain't going nowhere farther. I going right to Florida if that's the case. But like I said, that's a big question mark.
I had a big question mark until I found out the cost of the tickets to go there. I said, never mind.
Yeah. They say a car is $177 a day. On up.
Yeah, I think to leave Friday, come back Monday, the car was a regular small car now. You ain't getting this ain't getting a Jeep or nothing like that. A red car was $491.
Because all you gotta keep looking at them prices because I was looking and one day, right, the Florida was 800 and then the other day was 400. Then the next day was 300. Then the next day gone back to 12. I think
That's too much. That's too much looking. Too much
yeah, that's very
variation.
volatile.
I
You gotta
quit.
keep your eye on a hawk like a hawk.
No, I don't need to go that bad. They have COVID. That's okay. I can stay right here.
That's yeah.
Yeah, I can just read a book and watch a movie. That's fine by me.
Yeah.
COVID free. You could go. Have fun. I can stay right here.
Yeah,
Not
but I mean,
good.
it's a question mark for me, but I accompany someone to get some treatment. My mother-in-law.
Oh, okay. That's a little bit different. Okay.
Yeah.
Just be mindful now. These of them restaurants close.
Yeah.
You gotta figure
Well,
out you gotta eat.
if I go, cause she don't want, she's scared to get tested, so, but depend on what the doctor say, so.
Oh, okay. Well, she may have no choice, eh?
Yeah, that's why I say it's a question mark, so we'll see.
Okay. All right
Yeah.
then.
Anyway, y'all take care.
All
Okay.
right, everybody
Bye-bye.
take care, be safe.
Everyone.
Okay, good night.